Okay, so there are some differences, as we talked about earlier, with regard to the financial statements for a merchandising business, differences that we would not have for a service-related business. We kind of need to iron those out. And your slide says that that these differences primarily impact the income statement. And so I guess that's true because there are a couple of differences on the income statement, whereas with the balance sheet we have inventory for the first time. So that's one change. The income statement has a couple of things. We're going to look at those here in just a moment. So right here are the two changes that we see with the income statement for a merchandiser. Okay, and we call this a multiple step income statement because we're going to be separating our expenses out a couple of different times. We're going to have our sales, which is very similar to service revenue, right up at the top. Then we're going to have our first expense, this cost of goods sold, and we do that in merchandising because it is inventory directly related to the sales. Okay, so we take our sales and we subtract the cost of goods sold and we arrive at gross profit. We talked about that earlier in the chapter, but I just want to reiterate that. From there, one thing I don't see on this slide is our regular operating expenses. We would actually subtract those out, okay, and that would give us income from operations. And then we would have our other revenue and expenses, okay, things that are, these are minor, one-time items that are not related to our day-to-day operations, but they impact our profitability, so we do have to account for those. All right? So, as you might have assumed, that whether we're talking about a multiple-step income statement or the simpler single-step income statement, sales represents the total amount of sales to customers for cash and on account right up at the very top. Okay, and we should probably say net sales because remember we have all of those, we have sales returns and allowances, all of these kinds of things that will bring down what we call gross sales down to net sales, but that's what our sales represent. Hopefully you knew that intuitively. Okay, so we have our sales. We may have some returns, we may have some allowances, but now here we are back to this notion of cost of goods sold. Cost of goods sold, again, an expense item. Often for a merchandiser, it is the biggest by far expense. So here we have the cost of goods formula again. It says beginning inventory plus the purchases minus ending inventory gives us our cost of goods sold. Okay, what we cannot do is say, okay, we bought this much inventory and this is our percentage profit on each item. We can't do that. We have to do it this way because we could underbuy inventory. In other words, we're selling inventory that we bought last year, okay? Or we could overbuy inventory. So we have to use this formula to determine what our true cost of goods sold is. All right? So we have at the very top, we have our sales. We have our sales. And we're going to subtract from that cost of goods sold. And that's going to give us gross profit. If you don't believe me, you can look right here. We have net sales revenue. They're saying net here because we have to understand that we may have some returns or some allowances of some type. So we're going to take our net sales revenue and subtract cost of goods sold as an expense, and that's going to give us gross profit. Okay, that's the formula for gross profit. That does not mean that we've made a profit. Okay, gross profit only discusses our profit when we subtract cost of goods sold from sales. So you don't ever want to confuse this with operating income, and certainly not with net income, because they are very, very different things. All right. Let's see. I think I skipped a slide. I did. Okay. So it says here, income from operations, sometimes called operating income, it's actually always called operating income, is determined by subtracting operating expenses from gross profit. So we've already talked about how we get to gross profit. That's sales minus cost of goods sold. Then we're going to separate out or subtract out all of our operating expenses and depreciation. Now, depreciation is an operating expense. So the only reason that I can think that, whoever made this diagram, and I borrowed it for this presentation, but the reason I think why they're separating these two out are these operating expenses here are ultimately going to be paid in cash. Depreciation is a non-cash expense, but make no mistake, depreciation is an operating expense. So I would say that the formula for income from operations is strictly gross profit minus operating expenses, and that gives us income from operations. Okay, that's not, and this is still not net income. It may or may not be. Usually it's not, because we usually have a few peripheral items that we have to account for before we can fully arrive at net income for a company. Okay? All right, so we do have this other revenue and expense, and it's hopefully going to give us some examples here. Examples of other income and expense items include income from interest, would be an addition. Maybe we have we've sold some goods, we've allowed some extra time to pay above, maybe we sell on credit for 30-day periods, but we make a sale and we allow the customer to pay in 90 days, but we charge them a small amount of interest. Okay, we make an exception for them. So this shouldn't be a major source of income, but if we make money from interest, we have to include that. We might have a bank account or a CD, a certificate of deposit, where we earn a little bit of interest. We have to include that because it contributes to net income, but it again is other revenue. Conversely, interest expense, maybe we pay some interest on some assets that we've purchased. Think about if you were to go out and buy a car, you would pay some interest there. That would be other expense. To me, this is much more closely related to an operating expense, but I guess we're going to put it under other expense because we didn't have to incur interest expense if we had paid cash. So rent, an example of that, we had that little what was it? It was the Paul's Guitar Shop, and that was a single step income statement. But I believe they had some let's see, was it rental income, or I think they had some revenue from lessons. They sold guitars in their shop, but they could have very easily taken part of their shop and maybe rented that out for lessons. Maybe guitar playing professionals could give lessons there and rent the space from them. And then we kind of talked about gains and losses. Maybe we buy an asset and we have to sell it really quickly because it becomes obsolete, and in that case we might have a loss, or we'll get into gains later in the course. But these are all examples of other revenue and expenses that will ultimately impact net income. Okay, this is kind of a minor part of the course, but as you go through your textbook, you are going to see these types of items, so we do kind of have to talk about them. All right, and then our closing entries are the exact same as they were for the service-related business. The closing process, there's really no difference whatsoever in the closing process for a retailer versus a service-related business. we're going to close out all of our temporary accounts, just like we did for the service-related business. So temporary accounts, if you recall, are any income statement accounts plus dividends. So if we think about that for a moment, it's the exact same, except we're also going to close out cost of goods sold, right? Because that's an income statement account, it's an expense account. So that would be probably the only difference. So here we have some examples of some closing entries. If you recall from the chapter that you just had, we have a 4-part process to close the books. We have to close out sales. We have to close out our expenses. We have to close out income summary. And then we have to close out any dividends that we paid. So if we were to look at this, really the only difference that we would have is right here, cost of goods sold. It's just another expense that we have to close out. And as I told you before, it is a major expense. Looks like all of our expenses combined in this example for this company, whoever it is, $628,000. Cost of goods sold makes up well over 80% of all of the expenses. Okay? So, but the closing process is virtually identical for a merchandiser. And again, we're going to prepare a post-closing trial balance after we make those closing entries. All right, that's everything that I want you to know about merchandising businesses. We moved through it in quite a few videos to keep them a little bit more bite-sized, but hopefully you've gone over all of them. If you haven't, I do encourage you to do so. All right, that's it for retail merchandising businesses.